I couldn't find a single bank that failed because it didn't innovate. Not a single one. I mean, I've studied hundreds and maybe thousands of these things. But you know
Hmm.
what I did find? I found a whole bunch of them that innovated too fast without respect for the margin for error.
Welcome to the Operate Podcast, where we give you a behind-the-scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate Podcast. I'm Kerry Ransom. Today's episode is sponsored by BankTech Ventures, the first strategic investment fund designed by the community banking industry for community bank innovation, investment, and change. BankTech identifies leading products and technologies for community banks and works with the founders and management teams of those companies to help them maximize the impact they can have on community banking and their businesses as well. If you're a bank who's looking to innovate and invest in your future, or a founder who wants to work more closely with community banks, reach out to BankTech Ventures at banktechventures.com. My guest today, also a huge aficionado of community banks, is John Maxfield. He is the guy behind Maxfield on Banks. I've been following John's work for quite a while, and let me tell you all, he is one of those rare people who can make banking both fascinating and understandable. He spent the last 20 years getting to know many of America's best banks, and more importantly, the people who run those banks. And he's kind of acting almost like a detective, uncovering what make the great ones work and tick, and placing them in their role in the history of this industry. He's also running these really cool banking symposiums where he helps bring people together and help them also orient to the history of banking. He's done it in Philadelphia and even recently in Dallas. Before all this, John was also spent time at the Motley Fool. He was a bank director. He even has a law degree. And what I really love most about John is how much he just invests in learning. And he is on a mission to show everybody that banking isn't just about numbers and regulations. It's about the people, it's about the communities, and it's about the impact that they all have when they work together. John, I'm super excited. We finally get to record a conversation. It's been so fun getting to know you. Thanks for joining me today.
Carrie, it is my pleasure. And let me get back at you. The reason I'm doing this podcast and the reason that Carrie and I have developed a relationship is because Carrie is one of those guys who truly cares about the banking industry. And he's doing his absolute hardest with his team at bank. And they're not paying me or anything like that to say any of this. Let me be very clear. But these are people who are out for the banking industry. And that's what I'm out for too, is to help the banking industry be its best every single day. And so it's just a special relationship for me, Carrie. But let me say one thing before we get started. Like, I'm somewhat of a misunderstood character in the banking industry. And some of that is intentional because I've had to create kind of this character, to kind of operate in public, But the reality of the situation is like, I am like the kindest, most sensitive person you could ever meet in person. Do you know what I mean? But I have to put up these defenses kind of in the public because when you're somebody like me, like you're in a lot of eyes. And so you get a lot of criticism. And so I just want to be clear that like my public persona on Twitter, that kind of rough, aggressive public persona really doesn't represent who I am. I'm somebody who just cares about what they do and works really hard.
And I know that to be true, obviously, with a lot of the things that you're starting to put out now about some of the banks as well, John. It's just coming through so clear how much you care and how much you want others to understood what to many is a misunderstood industry.
I mean, the thing about it is that like earlier this year, I went on a road trip where I drove across the country from Portland, Oregon, which is my home, out to New York City. And all along the way, I visited banks in all these like towns and cities and stuff like that. And one of the things you realize when you do something like that is kind of the condition, the state of the middle of the country right now. And a lot of these towns are really, really struggling. And it's the difference between opportunity for children and not having opportunity for children. Mm-hmm. And the difference between a town with a locally based community bank and a town without one is a dramatic difference. And so when we think about if we want to protect these people in the middle of the country, community banks is a really important tool through which to do so.
Oh, such a great place to jump off. So before we get into some of the technical stuff, because I do want to delve into some of the technical things that you've learned. But let's start with how or what sparked this interest in banks. And I wouldn't even call it an interest. I would call it a deep passion and obsession. Most people just don't wake up and become or decide to become an expert. So tell us that story.
Well, so that's just kind of a product of how I've lived since I was a child. So ever since as long as I can remember, I've just gone subject matter by subject matter in my life. That's kind of the thing that interests me, is learning something, but not only learning it, truly intellectually mastering it as best as one possibly can. And so I've done that with a whole bunch of different stuff. I mean, high altitude mountaineering, maritime, how to survive maritime disasters, geopolitics, history in different regions and different times, all sorts of stuff, religion, philosophy, all different things throughout my life. And the financial crisis hit in 2008. My family were big bank investors. We've been investing in private banks for generations. And so my family's balance sheet is in large part invested in community banks. And so when the financial crisis hit, I was like, well, why did that happen? I want to understand why this happens, both to protect my own balance sheet and my family's, my more extended family's balance sheet. So I just started reading, and I fell into the same pattern that I've followed with all these other subject matters. And what I thought was that it would take like 6 months to a year to master banking, because banking is not a complicated subject. It's simple. But that's one of the reasons it's so hard, because humans don't like to think that they do simple things. Do you know what I mean? So I learned everything that I could about banking, and then I kind of did it in different stages. I went through, like I said, all the data. I've read a bunch of the books. I've met a bunch of the people, and then I went on road trips so I could physically see the industry with my eyes. And along the way, what I realized is that I have a process through which I break subject matter down into kind of like how I simplify it for myself. And I simplify subject matters down to a single simple underlying principle that is robust enough to explain everything that happens in that environment. Okay. And so when I was doing that with all these other subject matters, what you learn when you do this is that there's this invisible scaffolding that exists behind every subject matter. And it's the same exact scaffolding. So if you learn how to climb it in one subject matter, you can climb up another subject matter much more efficiently. And so as I was climbing up that scaffolding in banking, I could never get to the top. I mean, I was going for years and years and years, and I just could not figure out what was wrong. And what I realized is, so then I get to a certain point. I mean, I'm just like 12 years in, 13 years in, something like that. And I just can't reduce it in the same way. And I thought it would take 6 months to a year, And so I couldn't reduce it in the same way. And so I thought, well, look, here's the deal. I cannot commit the rest of my life to a thing that I can't figure out. So I'm going to give myself 12 months, 365 days to figure this out. And if I can't figure it out, then I'm moving on to something else. And so what I did is I allowed myself to work 18 hours a day for every single one of those days, birthdays, Christmas, everything. I worked 18 hours a day. And what I did is I started in the year 1790, and I read contemporary materials about the banking industry all the way through to 2022 or to 2020. Every single year, I read what was going on in the banking industry. I brought it all the way to the present. Okay. And then when I stepped back and looked at that, I realized that the reason that I hadn't been able to reduce it in the same way is because there is a very nuanced flaw in kind of the theory of banking that had been kind of set in the foundation that we hadn't realized. And that flaw is that the scholars, there's a thing called periodization where if you want to master subject matter, there's different intellectual verticals you have to master. There's the analytical vertical, there's the behavioral vertical. But another one of the verticals is the historical vertical. And so when you go through the historical vertical, the only way that you can truly understand the history of a subject matter that goes back like 230 years like banking does and has a pretty consistent history is to break it down into eras. And that is called periodization. Okay. And that's what historians do. That's something that applies in the academic context. Where this comes into play in banking is that you take that periodization over into the banking industry and you compare it against the data. And what you find is that the way the scholars had broken the periods down cuts right into the middle of these big mega cycles in banking. And so that's why I wasn't able to reduce it to that single simple underlying thing at the time, because we put all the things in the wrong piles. And so then once you sort all the things into the proper piles, then you can step back and look at it and think like, okay, now we can start to make sense of this thing.
So fascinating.
Let me give you a metaphor that'll help you understand this better, okay? Let's say you walk into a room and there's we have kids. Yeah, I'm sure you've been through the Lego stage, sir.
Yes.
We've all been through there.
Absolutely.
God, it took so much money. Jesus.
What a brilliant business Lego has.
Wonderful. Yeah. Anyways, let's say you walk into a room and there's a giant pile of Legos, and it's like the castle Legos, like the jungle Legos, the Star Wars Legos, and they're all mixed together in a single pile. and you come in and you say, John, I want you to build me a castle. You got an hour to build me a castle. I look at that process. There is no way I'm going to be able to build that castle. Let's say you walk into that room and all the pieces are separated into the appropriate pile sitting right next to the instructions. And you say, John, build me. I'll say, I'll get you that done. I'll get that done in 3 minutes. And so the proper periodization is the putting the data, the facts, the things that have happened into the appropriate piles. And then once you put them into the appropriate piles, you can step back and be like, okay, now we see the big things that are causing these shapes and shifts in the curves.
Mm-hmm. And you feel like really this is the first time that that's been this well understood.
So there are a number of pieces that have been understood in the past. Okay.
Mm-hmm.
So the way that the scholars explained it works up until about 1879. So that area that works for that period. Bernanke has then explained kind of the 1970s forward, but nobody has put these things together and then put that middle and then filled in that middle spot and then stepped back and then drawn conclusions from it. At least nobody that I've been able to read about. And this is not because I was trying to do this. I was just trying to figure out how this stuff worked. Do you know what I mean? But it turns out I had kind of had to figure it out on my own as opposed to just read a book that explained it.
Sure. And so now that you have that, do you feel like this better explains what is likely to happen over the next 10, 20, 50 years? And as you see these dynamics changing, whether it's private credit, which has exploded, or DeFi, which is starting, are those things that you think will also be able to be explained because of this? Or are you isolating it almost exclusively to just, how we would in the modern era traditionally think of a bank?
So what this framework gives you is it bolsters your ability to make the right decisions at the right time on the individual level, the institutional level, and the industry level, because it explains how all these pieces work together. And so another one of the dynamics of banking that's so unusual is that, so let's say, you run a shoe store and you want to increase sales. Well, you just reduce the price of your shoes, right? And then you can dramatically increase your sales. But it's there's a limit to how many shoes any one person can buy, right? And so there's kind of a set limit on how far you can grow as a shoe store or your typical business, right? Even if you drop the price to $1. Same is not true with credit. You drop the price of credit far enough and ease up enough on the terms, and the demand is absolutely infinite. It just goes straight up. And so what that means is that puts the onus on the banker to govern their own growth as opposed to the market governing it for you. And that's a really hard thing to do because we are all greedy. We are built as greedy individuals. That's how we are built to survive. Do you know what I mean? And so when you take that into this context, what that translates into is people that are trying, the opportunity to bolster your own short-term compensation by growing artificially fast. Do you know what I mean? And just hoping that you can skate out of it. What this does is it kind of explains that that it gives the people who are really good bankers kind of cover to be no. There are times when the best thing to do is absolutely nothing. And that is an important message in banking, a really important message in banking. On top of a cycle, the best thing to do is sometimes nothing.
Sure. Well, it's interesting, John. I know recently I was talking to a banker who was part of a de novo bank that they had started several years ago, and they had grown nicely. But his ultimate conclusion was, we can't grow fast enough to make this worth our while in an era where a minimum size for a viable bank has also changed. And so they ultimately decided to sell the bank because they felt like the minimum viable size didn't make sense like it did maybe 20 years ago. So how do you think about that? Plus, in some cases, the regulators are the governor on your growth because they're holding you accountable to a business plan, especially as a new bank, as an example.
So your point about the bank saying that they didn't think that they could grow fast enough, what they're saying is they didn't think they could grow responsibly fast enough.
I think so.
Yeah, they would be right. I mean, it's when you start a new bank, unless you have like a guy who's or a woman who is a big person in that market and they're bringing their whole book over, yeah, it's not easy to grow these things, and particularly
That's
if you
right.
want to grow responsibly. So yeah, so
And yet, would you agree that the minimum viable size has also changed because of just the cost of labor, the cost of systems, the cost of compliance, et cetera, that what maybe you could do with $100 million asset bank 40, 50 years ago or 25 years ago, now, maybe you need to be $1 billion bank to even make it worth your while to have an operating bank. So how are you thinking about that?
yeah, I mean, so if you look at these smaller banks, and it also depends what kind of charter you have.
Totally
You know what I mean?
depends.
You know,
Yes.
like the
That's right.
stringency of the regulations. But if you look at these smaller banks, I mean, like particularly like the OCC banks and stuff like that, I mean, like what they tell me is that it's almost impossible to fulfill that compliance burden at a smaller bank, because it's just like they're applying a lot of the same
That's right.
requirements to these big banks, to these small banks.
Exactly.
You know what I mean? And so there is an issue there. But here's the other thing I would say. You go around this country and you look at some of these banks, and you will find many banks that produce a consistent return on equity through multiple stages of through all the stages of a cycle. So we know it is possible, right? The question is just digging in and figuring out exactly like how they're doing and that kind of stuff, you know?
Well, just to go a little bit deeper on that topic, one of the things that I've been thinking about is, does a bank need to be more well-versed in its customers' businesses? Because not only is the market around banking, I mentioned private credit, fintech, DeFi, et cetera, but we now are in this AI era that I'm not sure we have any real precedent for. It feels to me to be the most profound change that we've seen in our lifetime, certainly. Do I need to, as a banker, where I'm a risk manager, do I need to better understand my customers than I ever have? Because I need to also understand how AI is affecting their business and what new risks that might be introducing as well.
Well, I'll tell you, these small banks know their customers very well. I mean, AI is one thing, and running into them in the restaurant at lunch is another thing.
That's right.
You know what I'm saying? And being able to hear like the scuttlebutt in the community. I mean, you can look up AI all you want, you know what I mean? But it won't replace the value of that kind of knowledge. You know what I mean?
Sure. Yeah, and I tend to agree with you. Like, those are my roots. However, I will also at times allow myself to imagine the other side and say, okay, we've seen some of these communities get left behind. And I will then start to question, why did that happen? And in some cases, that happens because people aren't prepared for change that's happening in our world. And it's sort of the defense, I'm going to let it happen to me, or offense, I'm going to try to find the opportunity in that change. And so that's where I sort of ask that question, is to say, okay, how are my customers? I could have a great relationship, but if we're all sort of living looking backwards as opposed to looking forwards, are we all going to meet the inevitable challenge, or are some of us going to adjust course or not?
So what you're getting at is a fundamental thing about innovation in the banking space. And it is my belief, based upon my research, that innovation in banking needs to be treated differently than innovation in a lot of other spaces, because the margin for error is so small. So you can't move fast and break things, right? So what that means is that innovation in banking is not 0 to 100. Innovation in banking is 1% every day. Innovation in banking is doing your best every single day. And what does doing your best include? Doing your best includes constantly looking for other ways and better ways to do things and serve your customers and provide your products and all those different things. So if you are doing your best every day, you are by definition innovating.
Yes.
And that's the way innovation in banking needs to be thought about. Because if you think about it the other way, let me give you an example. So I've studied bank failures, a lot of them, okay? And so like you have these people in the fintech space run around saying stuff like innovate or die, okay? And like these are clowns that wear like these Patagonia vests, and like they literally don't know what they're talking about. They literally have no idea what they're talking about. And let me tell you why. When you look at the history of banking and you say, okay, We have been through many of these periods. I know these people nowadays think that this is the only period where we've been through technological change, but that is not true. We've been through it since the very beginning.
Sure.
You know, and all the arguments that are made today have been made in the past. Do you know what I mean? When you look at bank failure, I couldn't find a single bank that failed because it didn't innovate. Not a single one. I mean, I've studied hundreds and maybe thousands of these things. But you know what I did find? I found a whole bunch of them that innovated too fast without respect for the margin for error. And so in banking, we have to respect that margin for error dynamic when it comes to innovation, and we have to be more gentle about it.
I think that is fantastic advice. So let's pivot to, you've identified some of the best bankers out there. And, you know, as an example, you highlighted Ross McKnight of InterBank recently. And I think you even described him as America's best banker. So when you think about him, maybe in the vein of what you just described, what makes him stand out?
Okay, Carrie, you ask good questions. Seriously. You're like, okay, I've done a lot of podcasts, and you're asking really good ones, okay? Ross McKnight is the Warren Buffett of the Texas Panhandle. He is one of the most special people you will ever come into contact with. I mean, he is an unusual character. And you say, so Ross McKnight, he has 3 empires, not just one empire, a banking empire, which is InterBank, is now based out of Oklahoma City. That's ostensibly where it's based, but it's really run kind of out of Fort Worth, which is where C.K. Lee is based. And you say, okay, well, like, he built this big bank, this banking empire from this tiny bank. He bought a failed Texas bank that he bought in 1988 for $5,000. And then he borrowed money from Scott Deeser, who runs First Financial in Abilene. Scott Deeser's bank is the only bank in America that's earned an annual profit for over a century. It's an amazingly well-run bank.
Great bank.
They would borrow and just continue buying all these banks throughout Texas. So they eventually built up this relatively large bank, and he owns 75% of it. Okay. And you say, okay, well, what is it that makes Ross? So that's the banking empire. Then he also has a ranching empire. He has an enormous ranch, and he also has an oil gas empire. And he makes all these things kind of work together. It's absolutely fascinating. But the question is, you say, well, what is it that makes Ross such a good banker? And so when I talk about like great bankers, what I mean by that is you have a decent amplitude of profitability that's consistent through time. The most important thing in banking is the standard deviation on your profitability through a full cycle. The lower the standard deviation of your profitability, the more value you will create over an extended period of time. Do you know what I'm saying? And so the question is, well, how do you maintain a stable performance? And the way you maintain a stable performance is one of the things you learn in banking is that banks move in herds. So when you look at like a chart of like bank failures back through time, it's not like one. It's like there's these herds.
Spikes.
You know what I mean? Yeah, exactly. And so what Ross is so good at is he is like the last person who's going to be joining any herd anytime soon or ever. Do you know what I mean? So Ross makes decisions based upon literally just what he thinks he should make decisions upon. And he's the type of guy that like knows his stuff, and he's constantly bringing in new data, talking to new people. So that ability to make independent decisions is the thing that has enabled Ross McKnight's bank to be so successful. And if you go through all these other bankers, you will see that independent of decision-making is the most important factor for performance over a long period of time. So then the question is, where do these people who have this ability to make these independent decisions, where do they develop that ability? Do you know what I mean? Because it's like, yeah, we can all say that, right? But like when you actually come down to doing it, well, sometimes it's a different thing. Do you know what I'm saying?
Standing alone is not easy.
Trust me, it's not easy.
Not easy.
Yeah. And so you dig in. So then you step back. So like at one certain point, like I'd gotten to know all these folks and gone through all the data, and then I put the bankers into these categories. These are who I perceive to be the best bankers in the United States. And you go through the data, and you can find no statistically significant explanation for why these specific group of bankers are all together. It's not like some of them have a lower efficiency ratio, some of them higher.
They didn't all go to Harvard. Yeah.
They didn't all go to Harvard. You know what I mean? It's kind of all over the place. But then what you do is then you're like, well, like, where do you even go with this? Then you got to step back, and then you have to say, okay, let's look at different data, right? Let's look at more subjective data to figure out if there's something else going on here. So then I stepped back and I thought about, because when I hang out with bankers, boy, it's like, we talk about all sorts, there's crying, all sorts of things, you know what I mean? Because like we're getting their story. I'm trying to learn who these people are. I care about these people deeply. and I'm trying to learn about them. And so when you go through that, what I step back and realize is that there's really two ways that you can develop that ability. The first is like, you just like the lucky gene pool, Jamie Dimon. Do you know what I'm saying? But even in Jamie Dimon's case, like, he was basically reared by Sandy Weil, like one of the greatest empire builders in banking, for better or for worse. You know what I'm saying? So Jamie is like a Bill Dimchek, maybe at PNC. Like, he seems like he kind of falls into that same category to me. But then the other category of CEO that has proven to be successful in banking and making independent decisions are those that have gone through some sort of wild, traumatic hardship or trauma in their life, and oftentimes early in their life. And you think, well, that is so unusual. Like, that certainly, this is a coincidence that these things go together. And that's what I thought. But then you step back and you think about it. And you think, well, let's think about this. Like, okay, this is the one industry in which these supply and demand dynamics operate totally differently. So maybe we need people who themselves operate differently. And so then you say, well, okay, what are the type of things that can inject you with such a durable change that you're actually able to ignore other people who are trying to tell you to do the wrong thing? And what you find is that these folks who've gone through these hardships and these tragedies, Ross McKnight, Richard Davis, Mick Blomnick, I mean, the greatest of the modern era, what they have is the ability to say basically like, look, I don't really care what you say. I don't care if you think I should grow faster in 2005 and 2006, because you know what? That thing that happened to me like 30 years ago, like, nothing you can do to me can compare to that. So I'm just going to go ahead and do what I think is right. And so, look, can you ever statistically prove this? No. But anecdotal evidence, let me tell you something right now. Anecdotal evidence beats R squared all day, every day.
That's so fascinating. Well, let's go a next level into that when you start thinking about leadership. So, these are very independent people operating a bank. They have to lead people. They also, in many respects, have to lead their board. Do their boards, bank boards, I'm guessing for the most part, don't understand this. For the most part, they want to follow the herd. This is for a lot of folks, a very clubby, comfortable role to play in their community. So how do you think about leadership, culture, leading people? And then how do you think about boards? Like, how do these people effectively lead when they're independent, often disagreeable? How do you create a culture of people who want to be part of this, even though you're winning? How do you get and operate effectively? And then how do you work with a board?
Oh, there is no better rallying cry to your people than independence. We are going it alone, and we are going to be brave. We are not going to be cowards about this, and we are going to do what's right, even though all the pressure on us is to do the wrong thing. I mean, there is no better way to rally your people than that, my friend. And I'll tell you what, I went up, I was just in Alabama for a week, and I met a whole bunch of awesome people. But I finished the trip with Brad Bolton up in Red Bay, Alabama. And you go into his bank, and he is a rebel. He is fighting for community banks harder than anybody else. Do you know what I mean? And you go into his bank, and you don't get the impression that these people don't like working there. You get the impression that these people find this to be a very special place, doing very important work in that community. And they are absolutely right about that. And so, like, you can be a rebel, and you can cultivate a very, very good culture.
That's exciting. Do you think that means you need a different board then too? Do you need a board who is going to just go along, or do you need a board that's going to challenge you to make sure you're continuing to be intellectually honest as that rebel?
The best boards are full of very smart, very strong-willed people who are all willing to voice their opinion on behalf of the institution, to protect the institution. You want people on your board who take their fiduciary duty very, very seriously. And you also want people on your board who understand the critical role that these institutions play in these economies. We are a credit-fueled economy. America loves growth.
Yes.
We do not have growth without credit. That's as simple as that. And when you think about, and that's on a national level, and it's also on a local level. If you go and you take these banks out of these small towns and you extract the money multiplier from those communities, they just wither and die. I mean, it's horrible.
And the funny thing is, to your point, there's an instinct to do more than you should, right? Like people want credit. So let's give them credit. Let's overextend. There's a natural conflict.
You are 100% right, Carrie. And it's one of the reasons the banking industry struggles with reputation, just because there's this innate tension in it. That is that, like, you protect people by giving them credit if they deserve it, but you protect them also by not giving them credit when they can't manage it appropriately. Right. You are protecting them both ways. But when you do it in the latter case, it's easy for the person who gets rejected to misinterpret it as something against you. You know what I mean? And so that's where the ability, like, you get a really good loan officer. My dad used to talk, I mean, he borrowed tons of money for his business. And he used to talk about how much he appreciated his banker, making sure he checked all these things when they'd go in and get, rollover stuff. Like, a banker can play an enormous, I'm preaching to the choir right now. I'm not telling bankers anything that they don't know. Bankers can play an enormous role in the health of these businesses. That
totally agree.
In addition to just injecting it with capital, being there to help them and answer questions, and you know what I mean. It's these bankers. That's the other thing about leadership.
And I think that's what we're trying to do, is trying to equip them to be even more value add. I mean, you think about me talking about AI earlier, and I agree with you that they know their customers, but I think there's an even deeper ability for them to know these customers through using technology even more effectively. And it's somewhat of a risk management function. I want to make sure that my customers that I lend money to are successful. What can I do to ensure that they are as successful as they can be?
Yeah, I mean, look, every tool that a banker can bring to bear to help their customers, they should do that.
Totally.
You know what I mean? That's the other thing about banking, Carrie, is that, like, to many people, once they get into banking, it's not just a profession, it's like a calling. And it's like, and that's what I have found. I'm not a banker, but you cannot deny the importance of these institutions to this country and to these towns and cities. And when you're somebody like me, you just can't ignore that. I mean, like, you're a powerful person. If you're someone in a position of influence, like, you are being derelict of your duties if you are just ignoring these really important issues. You know what I mean? And so we can't all tackle all of them, but we can all devote ourselves to different ones.
That's right.
And one of the ones that I'm devoting myself to is, like, this issue of community banks and how important they are to these local communities, particularly in these rural areas. And so, we'll all just do our best in this world, Carrie,
That's right. Well, John, on that note, how big, so I talked earlier about almost this idea of a minimum viable size of a bank, but how big do you think a bank can get and still be that relational and community oriented? Like, the difference between that true community bank and, call it, the regional bank.
Like, where what's the threshold at which you cross?
Like, what is it about? And there is always this, we love growth. Everybody feels this pressure to grow, but, like, what's the right approach there?
God, that's a good question. I'm going through my head right now, different banks at different sizes and how they act. And, like, you can have a $10 billion bank that's great on relationship stuff. You can have, 200 million, obviously, you can have that. I think that, like, it'd be arbitrary for me just to throw out a number.
Yeah. I don't think it's solely a size.
I don't think it solely is a size thing. I use First Republic. No, it's no longer with us, but think about First Republic. You know what I mean? It provides, it was a big bank, but think about the customer service that they provided. Now, at the end of the day, did it do them any good? I mean, it kind of showed us that the net promoter score in banking is maybe a little bit overrated, but that's neither here nor there.
Yes.
So.
Well, and I think for a long time, many of us outside of community banks have had a very low bar of expectation from our bank. So
yes.
Yeah. Net promoter score and actual value and good risk management may not be always the same thing. We're now in mid 2025, John. How are you feeling about banks right now? Like, we've just gone through this period of really spiked interest rates. I mean, one of the biggest short-term rises ever, if not the biggest. They've navigated through it somehow. We're seeing, higher for longer. I think we've all been counting on some rate reduction, which could be good for some banks and not so good for others, depending on what their balance sheets look like. But what do you see on the horizon for banks in the next couple of years?
Wild ride.
Yeah.
I see a wild ride. And the key will be maintaining your temperament and discipline and not making permanent changes to temporary issues.
Mm-hmm.
That will be a key through this period. So when you think about what causes the big shapes and shifts in the curves in banking, what you find is that the thing that really causes the mega cycles to get going is what I call novel liquidity surges. And that's when a bunch of new liquidity comes into the system, either from another system or up from the ground, from Federal Reserve central bank money. And so if you go back through time and you look at what you see through time is you see these novel liquidity events and the liquidity destruction events right afterwards. And bank failures and stock market crashes are two kind of the most effective liquidity destruction events. And so you see this just throughout time. Novel liquidity surge, liquidity destruction event, novel liquidity surge, liquidity destruction event, novel liquidity surge, liquidity destruction event. Okay. And so
we had the surge.
We had an enormous surge, the biggest surge ever in history, right? In 2021, what happened immediately after or real soon thereafter, right? We have the problems of Silicon Valley, Signature, First Republic, and Silvergate. You know what I mean?
Was that enough to offset it though?
No, because then we come in, right, and then we insure all deposits to stop the run, which is what we want to do. Because if you think about what happened there in in the first quarter, I think it was the first quarter of 20, or the first or second quarter of 2020, I think GDP fell on an annualized basis by 30%. And so if you're somebody who studied history, like Ben Bernanke, who was running the Federal Reserve at the time, he's a Great Depression scholar. You know that we've never experienced something that dramatic that fast before, not even during the Great Depression. And so that's why they flooded so much of that stuff in there. But so all this money comes in. We have these liquidity destruction events, the system trying to bring it back into equilibrium. We stop that. So what that means is that the system is still loaded up. It's still loaded up, and that's why we're seeing all this wild stuff going on right now. You know what I mean? We are in one of those times right now. You know what I mean? And so it's important to know that, and again, in environments like this, so there is the Panic of 1857. I love reading about contemporary reports about these panics because they're just totally wild. And there's a newspaper that kind of commented on it, and it was the first day the panic was going down, and it was just total pandemonium, you know what I mean? And the editor of this newspaper said basically there are times when it's better to do nothing than to just do something. And in the midst of these wild times, less change is sometimes better than more change.
Great perspective, and very different than I think most would prescribe for a scenario like this.
There's a time to do wild things, but it's not in wild times. The time to do things where you're breaking away from the crowd is at the bottom of the cycle, because you did the right things at the top of the cycle to enable you to then do things at the bottom of the cycle. And that is where value is created in banking.
Sure.
I mean, enormous amount of value is created in that
way.
And
that's where, people have failed banks to amass significant assets. Or, even classically, that's been a Warren Buffett strategy for a long, long time.
Yeah. Look at Johnny Allison, what Johnny Allison's built at home. Look at George Gleason, what he's built at Ozarks. You know what I mean? We can all agree or disagree with their methods, but they have created an enormous amount of value doing just that.
Yep. Well,
and Mick Blodnick did the same thing. Scott Deeser at First Financial has done the thing. Ross McKnight has done the same thing. When you study banking and you say, where does the actual value come from these big, big value creators, right? Does it come from their operations, or does it come from M&A? And what you'll find is when you kind of dig into this, you'll see that the majority of these banks that have grown like this and that have produced the most value across the country that is the method through which they have done so. M&T, Glacier, First Financial. I mean, it's an incredible. Think about buying a bank for $5,000.
Crazy. Yeah.
Crazy. And Ross McKnight offered $1, by the way. But the FDIC person that was down there in Texas was like, I cannot bring this back to the FDIC's office in Washington. They'll laugh at me. He said, she said, how about 5,000? He said, fine. And so his partner that he bought it with passed away a few years ago. But until literally this dying day, it's my understanding that he made fun of Ross and by telling him that he overpaid for that bank by $4,999.
Amazing. Amazing. All right, John, last question for this episode, because we're going to definitely have to do another one, what's your call for talent to get people to come work in banking? Because this is such a fascinating industry, such an opportunity for young people to learn about business, to learn so many things. What's your view on why should people think about community banking as a place they should go instead of Silicon Valley or Wall Street or something like that?
So I'm not somebody who talks in your normal terms in terms of like what's your career path or that kind of stuff. What I believe is that we are all put on this planet Earth to make as big of a difference as we possibly can. And we can all choose different ways to make that difference. You know what I mean? But the banking industry is an incredible way to make a difference in society. The stronger, the healthier the banking industry is, the better our country is. And so what I would tell young people is that working in the banking industry is a wonderful thing. These are people who care so much about this country and their community and their fellow citizens. Like, you will be working with wonderful, wonderful people, and you will be doing important work. And it is work that like not a lot of people give credit to. And so you can go in and make a big difference. It's somewhat of a smaller pond in that regard. So what I would tell young people is that, like, look, I've gone into it. Look who I am. I dress like a 22-year-old wannabe YouTuber. I'm absurd. But it is absolutely a wonderful and fascinating industry. And I would welcome all young people into it, and they can all reach out to me whenever they want.
John, thank you for joining me today and for becoming a friend. I so appreciate it and you, and look forward to so many fun times ahead.
You and I are going to be friends for a long time, sir. And we're gonna do good things in this industry together.
Amen.
All right, brother.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.